There are many factors that contribute to making a business more valuable. The ones that we see most commonly, probably 7 of them that I would identify in the first instance. So the first one is the company's area of activity. There are certain sectors of activity that are just perennially in demand. And as examples, I would talk about areas such as aerospace and defense. I'll talk about education. I'll talk about financial services, anything that is tech related, so software, IT services, telecoms, but also support services, facilities management. Those sorts of activities are always in demand. The second factor I would look at is the scale of the business. So put simply, the larger the business is, the more valuable it is, because it is more capable of withstanding the various shocks and impacts that businesses face over time. So scale matters. I think the third point I would look at is the revenue model, where you have a business that features a high level of recurring revenue. So I'm thinking here, the classic case would be a software business or perhaps a subscription-based media or content business. Those businesses are a lot more valuable simply because a pound of revenue this year is far more likely to be a pound of revenue next year because of the recurring nature of the revenue model. The fourth factor I would look at is growth. If a business is consistently showing historic and forecast growth, then it gives an acquirer the comfort that the products and or services offered by that company are in demand and will continue to be in demand. The fifth factor I would look at is profitability. So when businesses are valued, analysis of EBITDA is a very commonly used metric. So the more a business can do to grow its EBITDA and grow its EBITDA margin, the more value will be being created. Sixth point I would draw attention to is an absence of owner dependence. So what we frequently see with small businesses is that a lot of the value within that business resides within the heads of 1 or 2 individuals who want to leave the business, and for a buyer that creates significant risk. So the ideal situation sees a business owner building a senior management team, maybe 3, 4, 5 strong across different disciplines, that mean that when the owner shareholders leave the business, that they're not taking 90% of the value with them in their heads. And I think probably the final point I would identify is the makeup of the company's customer base. You want to avoid a situation where you have a single customer who represents too large a percentage of your company's revenue. So let's say, for example, we've seen plenty of cases where that percentage might be as high as 40 or 50%. And again, that creates risk for an acquirer because a single change of mind from that customer can lead to half the company's revenue disappearing. So those are the main factors. There are plenty of others I could talk about. Portfolios of intellectual property, talented groups of individuals with particular skill sets, for example, but the ones I've outlined there are the main ones.